here's the big thing that's helping rates be lower right now. We've talked about this a number of times, and it is the labor market, right? So we see inflation pretty much in check, and we see a weak labor market. So the thing that he's saying that could really push rates towards the higher end of his forecast is if we see strength come back to the labor market. So keep a close eye on that. I think that's pretty obvious to those of us that watch this all the time, but not everyone that watches this podcast is an expert at the market. So watch the labor jobs, watch the employment numbers. That's going to be, if we see strength come back in there, that's the thing that could push us up, but I don't see him going super high. He also says in here, I don't see a major breakout lower with interest rates. Like I don't see a magical refinance boom coming. But I'm going to talk about another article, in a future episode that I was reading. It might've been Logan's as well. I think it was on Housing Wire, but it was talking about the number of outstanding mortgages right now that are, that there's more outstanding mortgages above 6% than below 6%, which I thought was super interesting. I think that's what it was. We'll dive into it a little bit deeper, but it kind of challenges the idea of the lock-in effect. And is that really a factor that's driving seller behavior today, right? Because we all think the lock-in effect is a major factor, but is it really? We're going to talk a little bit more about that. Okay, so what he does say is, I have a tough time predicting rates go below the 5.75. And personally, that's kind of the range that, if you remember a couple episodes ago, I had Jason Obradovich on, and we talked about, kind of that high 5 range. I think anything with a 5 handle is going to be great in 2026, and I expect we spend a lot of the year in that range. As loan officers know, it's really tough being on that bubble, right? When rates are 6 1/8, like everyone wants to be 5.99. And so there's this psychological barrier when we're between a 5 handle and a 6 that make it difficult from a price comparison, and pricing exceptions and things like that tend to kind of get elevated a little bit in a market like this. So I don't love that aspect of it. But if we see rates in the low 6s, high 5s, I think that's going to, be very good for 2026. So I'm quite optimistic about all of this. Okay, so the bond market, if the bond market really fears a recession, you guys, I think that could be another factor that will help interest rates push a little bit better. And I think there was a big fear of that when the tariffs came out in 2025, and yet there was not a recession as a result of that. So it'll be interesting to see if this continued weakness in jobs and whatnot we start getting that talk of recession again. I've not heard that yet. So it'll be interesting to see what happens there.